hopefully you can hear me. I'm just trying to figure out how to work this right now. So if you see me, let me know in the comments. So I'm live here right now on YouTube up here, on Instagram over here, and on my Facebook group in front of my laptop. So good evening, everyone, from wherever you're listening, from wherever you're watching this video. Vishal, I think you're the first one on in the Facebook group, so welcome, TK, welcome there on Insta. Mehul, welcome. Siddharth, good to see you, my friend over there. Christos, good to see you. And we're on YouTube as well. So thank you everyone for joining. Hope you had a fantastic day. This live is going to be all about bringing you value. I don't do many lives. I mostly do YouTube. I mostly try to add value to you guys on Facebook and Instagram, but I hardly ever go live. So this is one of the few times where I am going live, and I can see that on Facebook, if I'm not mistaken, there are a number of people already tuned in. So I think there's 52 people on Facebook, which is great. Thank you so much. All right, Chandan, hi. Gold, hi. Saranya, good to see you. Maddie, good to see you there. So look, I'm very grateful that you're here. Let's get into it without sort of waffling on. Just a quick disclaimer at the start. None of this is personal advice. You know that. You're not going to invest in a property based on what you heard on Facebook, what you heard on YouTube, or what you heard on Instagram without getting professional help or personal advice. So this is none of that. And this is really just here. I'm here to really try to bring value to you guys. I think so many people in this day and age, you consume so much content. You consume content across different channels, different podcasts, and a lot of times the feedback that I get is it becomes quite overwhelming. Everyone has an agenda in real estate. Everyone is an expert. You hear this piece of advice from this person, that piece of advice from another person, and it's hard to marry everything up. And if you're brand new to property investing, what that generally means is that you just get so overwhelmed, right? So I'm just trying to be here with my property hat on and try to bring you as much value as possible. So if you could just start off by telling me where in Australia, or the world potentially, where are you actually logging in from? So put it in the comment section if you're on Instagram. I don't know how it works on YouTube, but if you can, tell me where you're actually watching from. And on Facebook, I can see so many of you logging in. Hey Heidi, hey Dave, hey Ashish, hey Babita, hey William, good to see you there. Bhavin, Ganesh, Zishan, Kylie. So tell me exactly where you're logging in from so I can get a sense of, who's watching. Are you watching from Canberra, as I see B Thakur on YouTube is? Are you watching from Melbourne, from Brisbane? I can see Vikram saying Brisbane Downs, Marcel saying Sydney. So tell me where you're logging in from, and that gives me a bit of context. And the second thing I want you to do before we begin, just second piece of request that I can send your way, is tell me, do you have zero properties? So are you brand new to property investing, or are you more experienced? Do you have more than one? Okay, so tell me, put a 0 in the comments if you have 0 investment properties. That's not a bad thing, by the way. Confucius said that we all start with the first step. The longest journey starts with the first step. I can tell you property investing is more than worthwhile. It has allowed me to escape the 9 to 5 in 10 years. I'm not special. It's allowed so many people to just have more freedom. It's not about getting rich. It's not about owning a Lamborghini. I don't have any of those things. It's just about getting freedom. So property is all about generating passive income, generating wealth so you can be more secure in the future and have more options. So it's really, really inspiring. So if you have 0 properties, let me know. That's not a bad thing. The longest journey starts with the first step, right? And if you have more than 1 property, so you're more experienced, let me know that as well. Just write how many properties you have, 2, 3, 4, 5, however many it may be. right? And that gives me a really good example, a really good sense of what's going on. So Emily's got 1, great stuff, Emily. Jared has got 8, good stuff, well done. Nathan 1, Vishal 0. Well, welcome to the course, Vishal. We're going to change that in no time. Ivarich 1, Michael 0. Look, Michael, I know you have way more than 0, so you're lying. Corey 2, great. Janet 0. Hey Benson, Isaac 0, great. So most people that are joining are actually new or newish to property investing, and that's great. And we're going to be covering some light topics today, and we're also going to be covering some heavy topics. I'm not a buyer's agent. I'm not going to withhold any information from you. I'm not going to give you some teasers and hopefully you pay me $15,000 to find you a property. That's not how I work. I'm all about education, right? So this live is not about selling my property investment accelerator, although I may leave the link below afterwards. I don't know how to do it right now. I don't want to touch anything in case it breaks. So if you do want to get formal, serious, systematic, data-driven education, I'm not going to plug it too much, but you can go to consultingbypk.com, but that's enough of that. In this video, I really want to add value. So some people have already asked me questions, in PM or DM or in the posts that I've done on my Facebook group so far. So if you've asked questions, I've actually made a note of a few over here. So we will go through them. And if you haven't asked any questions, but you have questions that you want answered, and presumably that's a bunch of you, I mean, that's why you're here. Look, this is a judgment-free zone. I don't know how to create a judgment-free zone across YouTube, Instagram, and Facebook, but this is. So please ask those silly questions. Please ask those intelligent questions. There's no such thing, right? I'm really just here to help you. So in the chat box, please ask your questions, and I'm going to try cover as many of them as possible. So the way that this will work for the next 40, 50 minutes is really, it's just you and me, right? I'm not interviewing anyone. We're not going to be talking about fluff. I'm literally going to be sitting here answering your questions. And hopefully, even if that just helps you want to take that next step to buying that high growth, positive cash flow property, that's my job done. All right, so please, 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 Jeff, give it a plug, mate. Come on, haha. Jeff, thanks for the encouragement. Yeah, I do too much sales and marketing, mate. I just need to back off a little bit. All right, cool. I can't read all these comments. There's so many of them, but please leave your questions in the chat box, in the comments. Without the questions, this live's not going to go too far. All right, so let's get into it. So I've written some down already. So the first question that I had from someone, apologies, I can't remember their name, but the question was essentially, should we buy in our own name or in a trust? Okay, so should we buy our first or second or third or fourth investment property in our own name or in a trust setup? Once again, at the start, I did my little disclaimer. None of this is personal advice. I'm not an accountant. I'm not a financial advisor. Nor do I want to be, actually. Not a conveyancer or any of those things. I'm just here to help you. All right, so there are 5 or 6 things you need to consider whether buying in a personal name or a trust. Myself, I have properties in trusts. I have properties in personal names. I have properties in companies. There's no good or bad. It depends on your situation. But here are some things that you need to consider. So the first thing is land tax. So generally speaking, in a trust, you have either no land tax threshold or you have a lower land tax threshold. So at some point in your property investment journey, you may need to pay land tax. That some point will come sooner, most likely, if you're buying in a trust structure. So that's one thing to keep mindful of. The second thing is negative gearing. So negative gearing simply means when you lose money in property, you get some of it back in tax. It's not a strategy, it's not a secret sauce or anything like that. It's just a tax outcome. Negative gearing is possible for you if you buy in your own name. It is not possible for you if you buy in a trust. So one other way to consider this is if you are buying positively geared property, and look, I probably had about 8 people joining my property investment accelerator in the last 6 or 7 days. And a bunch of people, quite rightly so, they have these aspirations. Oh, we want to achieve 150K passive income in 10 years' time, or we want to achieve 200K passive income in 15 years' time. Those are great aspirations and entirely possible, given you have the right financial wherewithal to do that. But if you seriously have the intent of achieving, let's say, 200K passive income or 150K, then buying all those properties in your own personal name is really, really, really tax ineffective, right? Because you can't distribute that um, across multiple parties. You cop all that tax in your own name if you're buying it in your own name. So that's one other thing you need to consider, the fact that in a trust you can distribute income to, let's say, your immediate family members or whoever's allocated that trust. The beneficiaries were in your personal name. You can't do that. And if you're buying negatively geared properties, then a trust may be less useful from that perspective. The next thing is costs. This is probably not the final thing, but the last big rock in the jar. Um, the costs of setting up a trust and maintaining it, I'm just using round numbers. It's normally cost me about $1,500 to set up for each trust, and it's probably costed me around $1,500 per trust to maintain on an annual basis. If you buy in your own name, there's none of those costs, right? So that's just another thing you need to be mindful of when making the decision, own name or trust. Now, there's so many property investment companies and gurus and all that kind of thing that kind of make up, I shouldn't say make up, but like they engineer fancy strategies like a hybrid trust that you should be investing in. To be honest with you, and this is not personal advice, for most people, just buying in your own name is more than sufficient. So those are some of the things you need to look out for. The second question that I got before I start with all the questions you guys have been asking, and I'm loving the banter, Michael. I think you're having way too much fun. So Jeff and Michael, cut it out, please. This is not meant for fun. This is meant for serious, boring education. So the next thing I'm going to talk about is a question that I got. PK, should we be buying a property and trying to pay that off? Trying to go principal and interest and trying to pay that off? Or should we be not trying to pay the principal off and actually use all our surplus cash from our savings and from the positive cash flow that property is generating to fund future deposits? Okay, so in essence, like I know a lot of people have this kind of mentality of, all right, well, I have my principal place of residence. I'm not going to invest in property until I have half of it paid off, or until I have 70% of it paid off, or if I have 100% of it paid off. And that will give me the confidence to go buy your next property. That's one way to go about it. That's super, super risk averse. That's super, super conservative. Most property investors, I haven't done the statistics, but I'm hazarding a guess. Most property investors, what they do is, as soon as they have equity available to them, they use a reasonable amount of that to fund the next purchase. So they're not paying the principal off. In fact, they're allowing the positive cash flow, they're allowing the equity growth to fund another deposit. That's personally what I did. So I started off about 10 or so years ago, bought one property that did remarkably well. It's probably down to luck combined with statistics, I don't know. That did really well, and then I used that to buy another one, and another one, and another one, and another one, and etc., etc., etc. Of course, if you only buy positive cash flow properties, that gives you the risk tolerance to buy that many properties and know that even with interest rate improvements, or rather increases, you can still fund holding that property, because rents rise, it's positive cash flow, you can handle it. So that's what I personally did, and what you can do then in the long term, once again, which was my strategy, is just sell 1, 2, 3, or 4 of those properties to pay off all the others, and therefore in 10 years time, or in 15 years time, or in 20 years time, or 25 years time, you have 3, 4, 5 properties completely paid off with no debt. The properties have paid themselves off. You haven't paid principal and interest, right? Like another way to talk about this is, and this is a very simplistic way to explain it, but let's say you buy 6 properties today. In 10 years time, easier said than done, you sell 3 of them, they've all doubled by then. You sell 3 of them, use the cash after tax to pay off the 3 that you didn't sell, And this whole time you've been on interest only. Now you're left with 3 investment properties, completely paid off, unencumbered by debt, giving you, probably close to six-figure passive income. So that's why I personally really recommend. I shouldn't say recommend because everyone is different, but I lean towards the interest only strategy because holding multiple assets as they all grow, that's the way to create wealth. Long answer to a sophisticated question. We go through this in much, much, much more detail in module 1 of the Property Investment Accelerator, really making sure that we model out a person's situation to the T so they can be comfortable in their strategy. All right, so the next thing I'm going to talk about before I start your questions, this is the last thing before I'm going to go with the questions, guys. Breathe. Is how do we buy interstate? All right, so I know by looking at your comments on the Facebook group that most of you are in Sydney and most of you are in Melbourne, right? And keep the questions coming, guys, and keep telling me exactly where you live in the comments so I can get a gauge for that. But most of you are in Sydney, Melbourne. Now, the situation in Sydney, Melbourne is that property prices are damn high, right? And they've gone up like, a bazillion percent in the last 2 minutes. Like, that's the reality of Sydney, Melbourne, right? Of course, that's hyperbole. But then what people think is, all right, well, I need to start investing in property. I can't do this in Sydney or Melbourne because I don't have $1 million to spend and I don't want to buy a negatively geared property. Like, tell me if that's you. If you're living in Sydney and Melbourne and you want to invest in property, but you don't want to pay 10 or 15 or $20,000 every year to hold that property because everything in Sydney and Melbourne is negatively geared, and you want to buy a positively geared property, tell me if that's you. Put a yes in the comment section, in the chat box. Leave a yes so I can see that that's you. But I know that that's a fact from all my calls every single day. So many of you want to buy interstate. You're looking up at Queensland, you can get at WA, you're looking at South Australia, but you have no idea how to do suburb research. You have no idea how to actually execute that interstate purchase without using, wait for it, a buyer's agent. All right. So the question was that someone asked me before: how do we buy interstate without using a buyer's agent? It's super simple, right? In week 2 or module 2 of the Property Investment Accelerator, we talk about suburb research, right? Suburb research is based on data. Suburb research has nothing to do with how the pavement feels on the soles of your feet as you walk around that neighborhood, or what the smell of the roses, the fragrance they emanate as you turn the corners around that neighborhood. Suburb research is all about data, right? And it doesn't matter if I live in Denver, or if I live in Dubai, or if I live in London, or if I live in Hong Kong, or if I live in Taiwan, places I have clients right now. You can figure out exactly where to buy in Australia, anywhere in Australia, just using data. So that's one thing. Happy to expand upon that if you guys want to. But the real second reason, the real way that you make a buyer's agent completely redundant, completely obsolete, and if there's any buyer's agents watching, much love to you, is property managers, right? People don't understand just how powerful, just how remarkably important a property manager is in your team. Now, just today's Monday, so just yesterday on Sunday, I posted a deal on the Facebook group. I haven't posted the interview yet on YouTube, but it's coming, same on Instagram. But it was a client, his name was Bikram Jit. He lives on the East Coast and he bought in Perth. Now, he didn't fly to Perth to buy this property. We found a really good property manager, and that property manager, A, did the inspections for him completely free of cost. B, did the pre-settlement or will do the pre-settlement inspection completely free of cost. And C, will manage that property, that's obviously not free of cost, but in a way that's trusted, in a way that he can rely on. Now, not all property managers are like that. You need to find good ones. You need to know how to manage them as well. But having a property manager allows you to buy anywhere in Australia without having to catch flights, without having to give up your weekends. What you need to do is you need to find the suburb and you need to find that property. And in fact, they will do a better job than you at inspecting that property than you and I could anyway. I mean, think about it. like I'm here in Brisbane right now. Many of you are in Sydney, Melbourne. You know, let's say we're buying in, um, let me give away a suburb, all right? So one of the suburbs we were buying in very, very heavily mid last year was somewhere called Tingira Heights. That's in Newcastle. Look it up. Tingira Heights, like the data was basically perfect. You could buy in Tingira Heights for about $550 to $570,000 last year. Most of our buying is under 500, but just to give you an example, now that thing is worth close to $700,000. Look it up. I'm not making this up. You can find it out yourself. Now, so many clients bought there, not having to travel there. They simply did that by having a property manager that inspected their property for them. And that property manager did a much, much, much better job than I could, or you could, or anyone could, because they know the rental market. They know exactly the types of bedrooms, the features of the house. They know exactly the right localities, the right nooks, the right corners, the right streets in that neighborhood. They know exactly what tenants want. And so therefore they can give a much richer experience of an inspection than you and I could anyway. I mean, if I walk into a house, I'm like, great, there's no cracks. There's a roof and the paint looks good. Like, I'm pretty amateur. But a property manager does this way better than you and I. In fact, when I buy in Brisbane, I don't inspect the properties myself, even if they're just 20 minutes away. Property manager does that every day of the week. And it's so easy, it's free of cost. I just don't understand why people pay $15,000 for the privilege to do what a property manager could do completely free of cost. All right, so that's what Bikramjit did in Perth as well. Like I was saying, he bought that property, I think it was $15,000 under market value because he got it off market. Once again, everything done remotely. You can do all of this stuff remotely, guys. So I'm going to start looking at some questions. Facebook is hiding a lot of questions, I think. So I'm just going to start at some random place. All right. So Ramakrishna, interest only or interest in principle for investment property. I just covered that, so thanks for coming. Andrew, any recommendation in choosing one of the big builders? Not sure who to trust. So Andrew, in terms of finding a builder, look, my recommendation is to buy established properties. They're low headache. If you find the right one, it can be low maintenance, easily tenanted. You don't have this issue of finding a builder and managing that. But one of the key pieces of advice that I could say is make sure they're licensed. Make sure you ask them for at least 5 referrals, 5 homes that they've completed in the last 6 months, and ask those people what was the experience like, whether they went cost blowout, whether they did a schedule blowout. And the third piece of advice is always get a fixed contract. Unless you're very advanced, always get a fixed contract. You don't want to have any surprises. All right, cool. Next one. Sorry, there's so many comments are just flying away. All right. Chandan Bardwaj is asking, PK, house and land or existing property and why? Good question. It's a common question. Look, house and land, when it's packaged up by a property investment company, I'm not going to mention them, there's probably about 1,500 of them. The thing that is really happening with a house and land package, like let me tell you, I mean, I'm on the other side of those transactions. I'm also involved in development. So what we do is we find a parcel of land somewhere in the fringe suburbs, like recently we bought a strawberry farm. We cut it up. We make, nice, you could say, nice homes, and then we engage a company to try to sell those homes on our behalf. Now, they are terrible investments, and the reason they're terrible investments, at least the ones that the majority of people buy, is because A, they're in fringe suburbs. So if you're buying in Ipswich or Logan or Browns Plains or past North Lakes in Brisbane, these are all low demand suburbs, high supply suburbs. Prices aren't growing fast. They're generally not a good idea for that reason. Another reason is it's like buying a Mercedes deal out of the dealership. So I don't know how many of you have got a GLC or a GLE or something like that. Great cars, they drive pretty well. I'm an Alfa Romeo man myself, but Mercedes are okay. But as soon as you drive it out of the dealership, it depreciates. The same thing happens in house and land packages. You're paying predominantly for the building, You know, it seems nice, it's shiny, it's got a warranty, but the building is depreciating and the land parcel that you've paid for is not really as large as you should have gone for. So the land is what appreciates, the building is what depreciates, and the land you've actually not bought much of, right? So that's the problem with house and land packages. You're paying a developer's margin, you're making the developer rich, and you're really buying a substandard property. Now, I just want to balance that out. If you buy in a hot market, like right now, or maybe 2 months ago in Sydney, you buy in a place where really the data doesn't stack up too well, let's say Schofields, anything is going to go up. And this is really where a lot of people, you know, in communities, they say, oh, look, mate, you know, I bought a house and land package in Schofields 2 years ago and that thing has gone up 30%. Without telling their friend that they bought, you know, right at the start of a boom. And that friend's like, oh, well, great, you know, property investment company handles everything for me. I don't even have to pay them anything because, by the way, they get paid by the developer. It's got the warranty, gate depreciation, which, by the way, you have to pay back to the ATO if and when you sell, but another story. You know, and then they go out and buy a house and land package and the thing doesn't go up for 5 years. And it's because the person who actually succeeded bought just, you know, happenstantially at the bottom of the market. In normal times, over the next 20 years, you take an established property and put it next to a house and land package. The established property wins every day of the week. Okay, so why not get both? Why not buy an established property at the bottom of its growth cycle by picking the suburb properly and have it outperform a house and land package over the long term? So hopefully that covers the question. Tim Yuan is asking, hey PK, what is the best strategy for the beginner investor? Like gross yield 5.5% with positive cash flow. 100%, Tim. Like in my mind, very, very, very few of you should even entertain any property with less than a 5% yield. The reason is that it may scrape as being neutrally geared or positively geared right now, but even though interest rates are unlikely to increase for the next 3 years, as per the Reserve Bank governor's statements again and again and again, in order to actually, you know, call it retire or achieve freedom or independence or some semblance of security in 10 or 15 years from property investing, we want to safeguard, we want to set ourselves up so that we're not taking too many risks. And if you're buying, you know, yielding property of under 5%, you're just telling yourself that in 5 years' time, I'm going to have massive headaches because this thing is going to be costing me so much more money with interest rates rise. So really the sweet spot where we're buying probably 4 or 5 deals every single week, not we, my clients, they're doing it themselves because they're educated. They're all kind of 5 to 6% yielding properties in high growth suburbs with some value add potential, hopefully under market value, whether that's off market or on market. So hopefully that helps. Jan, next one. All right, so Emily, so it's whatever's coming up. So sorry, I'm not going in any particular order. Emily is asking, do you prefer property management agencies that have one person looking after your property or a person per role, i.e. one person for maintenance, one for securing a tenant, one for inspection? So every single property management agency that I have working for me, whether that's in Tassie, whether it's in New South Wales, whether it's in Queensland or anywhere, I always have set criteria. Like their rent roll must be at least, you know, 3 or 350. They need to have the right systems in place. They need to have no more than 100 or 200 properties per manager. These types of checks and balances mean that the quality that you'll get is really, really, really good. Now, whether you want one point of contact or multiple points of contact for your kind of your property management needs is a personal choice. For me, I mostly just have one point of contact, and that makes things really easy. There are so many property managers in the market. If you just want one point of contact, you'll be able to find people that do that. Like, I just find that people are too shy, especially new investors. You're too shy to negotiate. You're too shy to ask for what you want from property management agencies, right? If you want a single point of contact, go for one that will give it. Property management agencies, like property managers, are so important. A talented property manager will literally get you to your financial your passive income goals quicker by reducing maintenance, by getting you better tenants, by getting you a rent rise every year, all these sorts of things. So if obviously one point of contact is better, and in most places you can actually find that. All right, hopefully that helps, Emily. Um, Rob Peter is asking, how do you find off-market properties? Great question. I actually have a whole video. I think it's like 10 or 20 minutes long, on my YouTube channel, completely free of cost, that explains exactly how to find off-market opportunities. So I'm not going to spend 20 minutes on explaining all the nitty-gritty. In my course, in the Property Investment Accelerator, we spend more than an hour with the right tools and strategies and templates to actually get off-market properties. But in a nutshell, it's super simple. You don't need to be a real estate agent. You don't need to be a buyer's agent. You don't need to have your your finger on the pulse, or walking the neighborhood, rubbing shoulders with agents to build long-lasting relationships. You don't need any of that. I'll give you an example. So one of my clients, Bennett, I'm not sure, Bennett, if you're on, but it's a really good example. He lives in Melbourne. He bought in a suburb called Highland Park. Once again, I'm giving you all these suburbs for free today. It's gone up too much, but that's one place where we were buying as well. Highland Park in the Gold Coast. He bought a property for, I think it was 554,000. The reason he was able to buy that property for 554,000, I think it was a four-bedder, 20 years old, 6.5% yield. Like, look it up. It's in my Facebook. Scroll down, search for Bennett. It was an amazing deal. 6.5% yield. This is not regions, right? This is Gold Coast. He got that deal because it was off market. He spent 3 weeks every Monday spending about 15 minutes on the phone, just, asking like 2 or 3 agents how they are. He was just explaining very simply, honestly, politely, courteously, that I'm an investor, I've got pre-approval, I'm ready to go. This is what I'm wanting, that's what I teach in my course, this is my criteria. If you have anything, let me know. And one day on a Wednesday, I think it was, there's an interview on YouTube as well if you want to go check this out. Bennett Christian is his name. One day the agent rang him up and said, "Oh look, last night there was a vendor. I think it was a divorce or retiring. I can't remember. It's in the video. They're a little bit embarrassed about their situation. They don't want to have open inspections. They don't want to list this thing on real estate. If you want to buy this property tomorrow, it's yours." And so he was like, "All right, well, how much?" And he got it for 554. Now look Highland Park up. This was literally in January or February. Look it up like after this session. Try to find a property in Highland Park that is half decent for under 650,000. It's not possible. Like, I challenge you, try to find something. So that Bennett, he recently immigrated from India to Australia, I think just 1 or 2 years ago. Brand new property invested, had no idea what he was doing. He previously went with a buyer's agent who got him a property in our favorite suburb, not Ipswich, that was just flat. And so he chose to do the Property Investment Accelerator. And this is literally as easy as it was. I don't want to come across as that it's, like a flick of a finger or anything like that. Of course, you need the right strategies, but it's literally as easy as a few weeks of agent cultivation, relationship cultivation, and they bring you the properties. In fact, there are suburbs in Adelaide we're investing in right now that real estate agents are actually working as buyers agents for my clients, right? So agents, because they want to sell properties, everyone needs to pay the bills. They need to sell properties to get paid. They know what my clients want, and they're going knocking on doors and trying to find vendors that will sell them the ideal property free of cost, because the carrot on the stick for them is they have a payday, a commission. These things you don't hear in mainstream podcasts, but it's so important to get off market. So hopefully that helps. Peter and Chandan, I see you ask the same thing. Lisa, hey Lisa, what is the price range sweet spot when investing in wide? Great question, really, really good question. And one myth that I want to bust is that you need to be rich to invest in property. Like most people, once again, it's kind of like a Sydney, Melbourne type syndrome, and nothing against Sydney, Melbourne people. I'm thinking about moving to Melbourne as well. you know, because Sydney, Melbourne's so rich, you guys think that you need to spend $700,000-800,000 on an investment property. I can tell you that if there was a bell curve, like a normal distribution, most of my clients in the last 5 years have bought between 300 or let's say 250 to 450. That is the sweet spot. There's no need to sacrifice positive cash flow in that range, and there's no need to sacrifice growth. So hopefully, simple answer. Hopefully that helps, Lisa. Um, all right. Dean Sanders, hey PK, just wondering which LGA local government area do you see growing in Sydney and by how much? Good question. Look, I think everything's growing, right? But I've actually done a video on this exact question on YouTube. I think I recorded it. Well, I did one in December 2009, and all those suburbs grew, all those LGAs grew by at least 100 to 250K in 2020, in the middle of COVID. And I did another video in January this year, and all those places have already grown by another 150. So the areas like around Leppington or Campbelltown, around Plumpton, which is close to Mount Druitt, Penrith South. These kinds of areas are super strong. Dean, you'll find out how to do this in week 2 when you get to it. Good to have you on board on the course. But seriously, you don't need to look in Sydney. It's not positive cash flow. To build a large portfolio, don't sacrifice positive cash flow. Okay, Maddie Single, what do you think the market would be doing in the next 2 years? Some markets might be better than others. 100%. 100%. Actually, it's funny. I had a client call, I think it was this morning or yesterday. I think it was today. And so he wanted to start investing in property, lives in Quakers Hill in Sydney. Nice person, really nice person, brand new to property investing. And you know, we had a call, like you can book a strategy call with me where we see if we're a good fit. So he did that. I'll leave a link below. Sorry for the plug. So he did that, and he really wanted to invest in property, right? And he wanted to build financial freedom, not to get rich or any of that sort of stuff, but just to have more options in life in the future, not have to work so hard. But after going through everything, you know, the price of the course was okay, the details of the course was okay, he built trust in me, which is hard to build. The reason he didn't buy the course, it was painful for me, kind of joking, but the reason he didn't buy the course is thought that the market has peaked, right? There's so many of you that think that just because Sydney has gone up, you know, maybe 20%, just in the last few months, that it's peaked. So many of you think that just because Melbourne's median house price is now $1 million, that it's peaked. The reality, as I think you're alluding to here, Maddie, is that in Australia, there are 15,000 suburbs. Of those suburbs, about 4,000 of them are statistically reliable. So what that means is that we have a universe of 4,000 suburbs that we can buy in. And now each of them are like stocks on the stock market, regardless of the ASX 300 rising or the ASX 300 falling. There are always stocks that go up the other way or down the other way. Let's take Afterpay for an example. You know, great, I wish I invested in that. Afterpay last year, when everything was going doom and gloom, Afterpay grew by, I don't know how much, like 100%. Don't quote me on that. So suburbs are the same. You need to analyze the dynamic between supply and demand, and that's not just one magic number for every suburb. And you can do that at scale. And if you can do that at scale using data system, then what you can find is at any moment in time, a suburb that is dropping, a suburb that is plateauing, and a suburb that is growing or about to grow. So I can tell you in 2015, when everything was booming, there was a bunch of suburbs going up. In 2016, when the market just started to cool off, 2017, the bottom of the market, or when the market, stopped growing, there were still suburbs across Australia that were growing. 2018, when everyone said it was a property crash, there were suburbs that were growing. 2019, when everyone was like, does property even work anymore? There were suburbs that were growing. In 2020, last year, when potentially most of you, including most commentators, including banks, including, you know, like $1 million salary economists were saying the property market is going to crash by 30%, there were suburbs that were growing. Right now, there are suburbs that were growing. Moral of the story is don't wait. The idea is if you know where to invest, if you can learn the data, then just invest, right? Not just blindly. Of course, if you invest blindly, you're gonna suck. Um, but there's always money to be made, and I'm not sort of saying, oh, look, yeah, suburb might go up in 2019 when the market was stale by 20 or 30,000. I'm literally talking suburbs. I'll give you an example. Like, why beat around the bush? Um, let's use a real example. So let's say 2020, no one was buying. If you had bought in a place like, let me use a area that we're not investing in at the moment. If you bought in a place like Stafford Heights in Brisbane, you would have made in the last year or last year and a half like $200,000. That's off a base of about 650. So that's an expensive suburb. Let's take a Ballarat. If you invested there in 2018 for $300,000, that same thing is worth $500,000. Now, 2018 wasn't boom time, 2019 wasn't boom time, right? So the point that I'm trying to get across is for anyone who's sitting on the sidelines thinking property market's gone up too much, it's not sustainable. Guys, there are suburbs in Perth that haven't actually gone up but are about to. There are suburbs in Adelaide that haven't actually gone up but are about to. There are suburbs in Brisbane that haven't actually gone up that are about to. On the flip side, there's so many of you, and there's literally so many of you on here right now, on YouTube up here. Thank you so much for coming. Instagram, and there's literally like 150 of you close to on my Facebook group right now. There are so many of you that might be thinking about investing in Tassie, in Glenorchy or Devonport or Burnie or places in Tasmania because you think that the market is doing well. That's just the opposite of Stafford Heights. That's just the opposite of Ballarat, where it's already done 60%. Don't invest at the top of the market, right? So there's always suburbs growing at any time, anywhere in Australia, but you have to find ones where the data suggests they will continue to grow and they haven't grown too much so far. Okay, hopefully that helps, Maddie. All right, Sibichan, I answered the off-market stuff, and welcome to the course as well. You'll find how to find off-market deals in a lot of detail in week 5, I think it is, module 5. All right, next one. Just scrolling down, and guys, if as I read these questions and answer these questions, just try to give me some feedback as well. Just tell me if this is making sense to you. Am I speaking too fast? Am I speaking too slow? Am I waffling on too much? Am I speaking am I too nervous? Give me some feedback and I can try to improve for you guys. Ashish Bhargava, giving depreciation back to ATO. Why? Good question. So Ashish, what a lot of property investment companies do, and you know the ones that I'm talking about, I can't name them here because I'll get sued for defamation, but basically 9 out of 10 Facebook ads that you see, they are trying to sell you off the plan apartments or house and land packages, saying that you'll pay off your mortgage in 7 years, or that you'll become rich in 7 years, or positive cash flow because you'll save $100,000 on tax through depreciation, all this kind of thing. Now, the thing with depreciation is this, and I'm not making this up, you can just Google it, go to the ATO website and figure it out for yourself. But let's say you claim $10,000 of depreciation every single year because it's a brand new property for 10 years. And let's say after 10 years, you sell that property. All of that depreciation benefit gets added on to your capital gains. All right, so let's say you bought that property for $500,000. It's not going to become $1 million if you bought through one of those property investment companies, but let's say it goes up to $600,000. Now, your true capital appreciation is $600,000, and ordinarily, if you had sold that, you would pay capital gains on that. But because you've also made your claimed $100,000 of depreciation over 10 years, you have to add another $100,000 on $600,000. So now that's $700,000 that the ATO views that property, $200,000 of gain. So you pay tax on $200,000. Now, if you earn $150,000 or $180,000 or even $100,000, and in 1 year you have to lodge a tax return with another $200,000 of capital gains, then you're paying close to 50% marginal tax on that, and therefore you're paying 50% of all that depreciation back. right? So there's still some benefit, but it's not a free lunch. It's short-term gain for long-term pain. That money that you get from depreciation is not really yours. They don't tell you that because it doesn't benefit them. And this is where education comes in. Chandan, thanks, PK. I appreciate that. No problem. Um, Pramila Reddy, where to find property managers? Yeah, so if you just joined, we spoke about before how you don't need a buyer's agent. A property manager does all your inspections for you. Where to find them? Well, in the Property Investment Accelerator, we give you tried and tested property managers, but you can do that yourself as well. Just go to ratemyagent.com or .com.au, I forget now, and you can put in a suburb there and you can just find top rated property managers. Of course, you need to have your criteria about who you go with, but that's a good start. All right. Varun Gupta, best suburb in Victoria for capital growth. I assume that's a question, and I have no idea how to predict capital growth. Varun, what I can do is I can predict, or we can predict relative growth. So if we put two suburbs side by side, whether they're geographically side by side or in different parts of the country, using data we can assess which will outperform the other. And when you extrapolate that to all 15,000 suburbs in Australia, then you can see which will outperform the others. If there's World War III and everything bombs, then yours will bomb too, but by less. But if it's normal and the market grows by 4, 5, 6% on average, then yours will outperform that by a long way. And like that's basically guaranteed because it's based on data and statistical algorithms. But in Victoria, which are the best suburbs for capital growth? Um, Look, if I had my negative gearing hat on, which I don't recommend, there's a bunch of opportunities still in Geelong. But if I have my, and actually I've done a video on this, it's on YouTube, it's free. I went around Melbourne and gave you the best capital growth suburbs, so check it out on YouTube. Once again, it's already done. But if you want positive cash flow, really your opportunities are places like Warrnambool, like Mildura, like Ballarat, like Bendigo. We're not investing in most of them anymore because they've already gone up too much. We want to buy at the bottom of the market. But to answer your question, all of those will continue to do well. Hopefully that helps, Varun. All right, so Zishan is asking I already have a property in Adelaide. Now I'm looking to buy another one in Oran Park, New South Wales. Is that a good idea? Or Cecil Hills? I don't know the data for Cecil Hills off the top of my head, but I can tell you Oran Park, I think that's close to Leppington, if I'm not mistaken. Oran Park itself isn't that fantastic. It's got a whole bunch of building approvals, some developable land on the south side, but it's in that cluster, in that little enclave of, I don't want to get this wrong, near Leppington and a few other suburbs in Sydney's southwest, where the data is actually really, really strong. So, are there better places to invest? Yes, but will that property plateau or go down in value? Absolutely not. So, you can do better, but you can also do much worse than that. Another question, where to find an off-market deal. So, guys, I've covered that, and if you're watching the replay, so I know a lot of you actually, there's only, well, not only, about 150 people or 200 people watching, across all the social channels right now. I'll post this afterwards, all this recording will stay, and if you're watching the replay, I want you to just comment in the chat box or in the comment section replay, hashtag replay, and that allows me to know that you haven't watched live, you've come back to it later, and you're watching the replay. So comment replay. But all of these questions you'll find have been answered when I started the session. So hopefully that helps, guys. Another question. Jen Lee, by the way, Jen, I just want to say thanks for contributing to the Facebook group. You bring a lot of education and knowledge to the group, so thanks for being with us. Your question is, should you sell a property after a flip or keep holding it? Now, my personal strategy, what I've used to, achieve my, this kind of sounds really slimy, but my six-figure passive income after 10 years, I never flipped properties. I renovated them for sure, but held them. So what we want to do is we want to buy properties, ideally off market or under market. We want to buy growth that's 100% of what we want to do. We want to buy positive cash flow. That's just a hygiene factor. But we want to buy properties with um, some value add potential. So I posted a deal a week ago on my Facebook group on a Sunday. Every week I post my client deals, but last Sunday it was a client who bought in Adelaide, in the south side of Adelaide. He bought a 760 square meter block that could be subdivided in three townhouses worth maybe 450 each, on 233 square meters each. That's what the zoning allows. He can make 200 or $300,000 if he wanted to. There's the whole client interview on YouTube. But I'm trying to give you an idea. That's the type of property we want, right? We just want a property that can either be subdivided or some sort of renovation, some sort of value add potential. So I don't like to flip properties. We want to try to find properties, ideally, if this is your strategy, where let's say immediately, or let's say in 2, 3, 4 years time, we can put in maybe 15, 20, 25K in a cosmetic reno, increase the valuation by 2, 3, 4 times, let's say 80, 90, 70, 80, $90,000 equity. And instead of flipping it, because if you flip it, you pay agent fees on the way out, you pay capital gains tax, all that stuff. You're not left with much money. You hold it, right? When you've renovated, you've increased the capital value of the property, you've increased the rent. Why not just keep it, all right? And when you keep it, that becomes your golden goose. That becomes your passive income source. That becomes the way that you can actually retire or reduce your working hours in 10, 15 years' time. So I personally like to keep them. Now, if you're doing more structural renovation, like you're happy to spend 50 to 100K and increase the value by 300K, that is when it starts to make sense to flip properties. That's when there's enough margin to actually flip. But then you need to be buying properties in the vicinity of $600,000, $700,000, $800,000 for that math to stack up, right? Typically, we buy properties under 500K, and you just can't buy a $400,000 property, spend $20,000 on it, and make it a $700,000 property. It just doesn't work. So hopefully that gives you some color. Jen, keep the questions coming, by the way, guys. And if I don't cover your question, what I'm going to do is I'm going to use it as stimulus for future content. So if you haven't already checked out my YouTube channel, it's called PK Gupta Property Investment Accelerator. We just hit 1,000 subscribers, so that's pretty cool. Thank you so much. But all your questions that I don't cover, I'll just convert them into videos for you in the future, and that would just bring you value. All the stuff that I do, I try to keep it free of fluff and keep it free of marketing. There is some marketing in there, but I just try to keep it pretty direct. So if you haven't checked out the YouTube channel, go check it out. Literally, I would guarantee that 60, 70, 80% of your questions will already be answered by one of the dozens of videos I've done before. So let's go to the next one. All right. Jeff is saying the definition of a flip is that you sell it. Really depends on your goal and how quickly you want to achieve it. Both have pros and cons. Yep, that's a really succinct way of saying what I said, Jeff. Thank you for that. All right, Maddie, what do you suggest for a mid-level investor with 7 properties, sell a little bit and diversify into development or commercial? Good question, Maddie, and a lot of you might not be able to relate to this because clearly most of you don't have that many properties, as you told me at the start. But the way that once again, I don't mean to toot my own horn, but just sort of sharing real examples. The way that I kind of really accelerated my passive income target and achievement of that target was with development. So what you generally find at the start of your property investment journey is that it's just so overwhelming. There's there's so much information, everyone's trying to sell you something, not sure who to listen to, everything's contradictory. But when you actually get educated and when you do buy your first investment property and it does perform, then you have confidence to get your second one and your third one. And then you start getting so much skills and experience and confidence that you start saying, all right, well, why am I just doing buy and hold? Why don't I kind of leverage into like Jen was saying before, why don't I do a flip? or at least some value add, like a renovation and keep it. And then perhaps after 7 properties, you're thinking, all right, well, I have $3, 4, $5 million of equity. I don't know how much you have, Maddie, but let's just say 2, 3, 4, $5 million of equity. Why don't I kind of pull the trigger and take it to the next level, right? And this is what I did. Why don't I do actual development? Now, a good residential development, a 1 into 3, um, should make you $200,000 to $300,000 of clear profit after a maximum of 2 to 3 years. That's a good development, a good residential development. I'm talking corner block, big house, subdivide the back into two townhouses, sell them for five, six, $700,000 each, renovate the front house. You know, you should be making $300,000 in that kind of deal over, let's say, 2 years. But to do that, you need a capital base of, let's say, 2 or 2.5 million, or total development cost of $2.5 million to actually execute. So, it's kind of like you need that initial equity to be able to do those deals, and you need to get educated on how to do them. Don't just give someone your money hoping that they'll give you a set percent return. That can work, and in fact, that's what we do. But you need to build a lot of trust with whoever you're doing that with. Commercial is different. So I teach commercial to some extent in my course, but let's say a service center, or service station, sorry, which is something that we're involved with. Let's say you build one, they can cost maybe $4, 5, 6 million. You know, the profit on one of those bad boys can be $1 million plus, but it's taking you 4 years probably from start to finish to do that. Like I said, you need that capital to start, you need investors, you need the right mindset because you're not getting a payday tomorrow. It's just more complicated. So to answer your question, Maddie, like I don't know if there's a clear answer. Like my experience has been, the risk equals return. If you have the risk appetite because you've got so many runs on the board with so many properties, then go for it. You can accelerate your passive income journey. But if you can't stomach that, if you can't go to bed knowing that you might lose some of your money, then for the average person, I would probably say don't rush in. Well, there's that saying, I can't remember, fools rush in where angels dare to tread, right? So all these things seem really shiny and sexy and all these things, but like whether you're buying your first investment property or your eighth and you're doing a development deal, education is so important. You don't want to make a mistake. Oftentimes people, including me, say the first property is your most important because it can set you up for a big portfolio. It can set you back 5 years. That's true, but it's actually true for like the third property as well, or the seventh property. Like if you take a massive risk, a massive gamble, and it doesn't come through, then you can go back to either square one or go back a few years, and you really don't want that to happen. Every single property shouldn't be playing Russian roulette at this casino. It should be based on data, it should be based on systems, it should be based on a team, and it should be based on proven processes. Otherwise, this isn't monopoly money, this is real money, your hard-earned money. All right. Zahid, what are authentic sources of data for suburbs? So this is a really good question, and thank you for sticking with me. We're almost at the hour mark. There's still more than 120 people on Facebook, so many people on Insta and also YouTube. Thank you for sticking around. We'll take a few more questions, but essentially, I get this question a lot. So there's so much data online. How do I know what's trustworthy? How do I know what's fake? You go to real estate, you go to SQM, and you go to On the House, and you get 3 different median values that might have a standard deviation of 2, or it might have a difference of $50, $40, $60,000. How do you trust data? So what we do is we go direct to the source. So there's so many data sources out there, like RP Data, CoreLogic, Residex, Investar, Price Finder, Australian Property Monitor. And what you get from all these people is you get PDF documents, or you get suburb by suburb views, right? You get like pie charts and bar charts and a whole bunch of stuff. It looks cool. It looks, like they know what they're doing, and they do. But it's not useful for us. And I'm kind of outspoken on this because I don't have a CoreLogic RP Data subscription, and I know basically every other property expert in Australia does. I don't even use them. And the reason is, number one, they don't provide all the data that we need. Okay, so they don't provide everything. So why pay $1,000 or $2,000 subscription? You don't have to pay a subscription, by the way, at all for what we do. But why pay that much money if you're not even going to get all the data factors that you need? The second thing is that they don't tell you the reliability of the data. So I said before that there's 15,000 suburbs, about 4,000 of them are statistically reliable, which means that there's enough listings or sales volumes in the suburb for the sample size or for the data to be robust, high enough fidelity. Now, if there's only like one listing a month, then the data can't be trusted. Like average vendor discounting, if we're only going by one, vendor's discount, that's not good enough. So all these providers like RP Data, CoreLogic, they don't tell you the underlying reliability of that data, right? It might show that all these demand metrics are going through the roof, but can they be relied upon? You can't tell. So for that, we need to assess that for ourselves, and we use that using the raw data by looking at something called statistical reliability. And the third reason why all these mainstream data sources aren't interesting, or sorry, not interesting, but aren't super reliable or super useful, I should say, is the way that they're presented. So let's say RP Data CoreLogic, it's presented in a way that there's bar charts, pie charts. You have to do it suburb by suburb. So you have to look at Oran Park, you look at Alexandra Hills, you look at Marangaroo, you look at Ferny Hills, all these different suburbs one by one. Now, if you genuinely want to buy interstate, and if you genuinely want to buy a suburb that is the best for your strategy, then it was literally going to take you like 3 or 4 years to analyze everything. By the time you're done, like the data will have changed, right? You can't do it suburb by suburb. So for that reason, we can't use these mainstream sources. We go straight to the raw data. So my clients and I in the Property Investment Accelerator, what we do is we take all 15,000 suburbs and we get all the data for them concurrently. And when we do that, then we can apply our data system, various metrics, average vendor discounting, developable land supply schemes, job advertisement trends, stock on market percentages, all these different, there's 30 to 35 factors. We can apply them concurrently on all the suburbs. And so then it just takes like 3 or 4 hours to pick your best suburb. You can't do that on RP Data CoreLogic unless you're just looking at 5 suburbs that you kind of already know because they're in your backyard anyway, right? So hopefully that helps. You need to go to the raw data. The raw data is not free. There's various sources of raw data as well. In fact, you can ask RP Data for the raw data. They think they charge like $5,000 for it. Where we use it costs about $150. All right. So Varun Gupta was replying to Zahid saying CoreLogic. So yeah, my answer was completely different. Kathy is asking your thoughts on older units. All right, so what do you think of older units? So in general, units are not a good idea. If you look at aggregate or average statistics, units underperform houses. Freestanding, freehold houses. If you just look at basically any city, any state for the last 10, 15 years or 30 years. However, this is a really good point that you're bringing up, Kathy, because there are always exceptions to any rule. And so I really like, not so much in Brisbane, because Brisbane is very much a house city, and there's far too much oversupply of units in townhouses. But if you look at Melbourne, or you look at Sydney, there are some inner city areas, especially on the east side of Melbourne, where like a 1970s, 1980s villa or bungalow, ground story, complex of 4, no pool, no gym, no fancy stuff, no body corporate that's through the roof, they actually make a lot of sense. So if you're kind of hell-bent on buying in a capital city, but your budget is like only $700,000-800,000, then you can go for a unit, but make sure it's not a high-rise, make sure it's already depreciated, you're paying for the land content, like a townhouse or a villa, or sometimes, I grew up in New Zealand, we used to call them flats. So those can be good as well, Kathy. Hopefully that helps. I'll just answer 1 or 2 more questions, guys, before we wrap up, because it is getting on, and I see a bunch of people logging off, because we were meant to finish at 9. So I'll answer one or two more, but I just want to say before everyone leaves, thank you so much for coming. And if you want me to do more of these, like I think the last time I did a live was kind of late last year. I've been spending a lot of time with my clients, getting getting good results. I post them every single week, at least twice on Facebook, at least once on YouTube. Interviews, the client numbers. I tag the clients like, guys, these are real deals. I want you to be inspired by them. All these people are not using a buyer's agent, they're not spending their weekends at inspections, they're not spending weeks doing suburb research, they're getting off-market properties under market value with positive cash flow and huge growth, so that actually they don't wait 2 years to extract equity, but actually extract equity in like the first 5 months, first 6 months to get another place. Right, so I post so many of these, so that's where I've been spending my time. But if you want more lives, if you want more of this kind of content, like there's really only one way for me to figure out that that's what you want, and that's for you to tell me. So if you want more lives, whether it's on Insta, whether it's on Facebook, whether it's on YouTube, please comment below live. All right, so I want you to comment below right now live, and in that way I'll just go back afterwards and see how many people commented the word live, and that will give me an indication that you guys actually get some value out of this. I don't want to waste my time. I don't want to waste your time. So if this was actually valuable and it's really adding a lot of benefit to your property investment journey, we can't cover every topic in 1 hour, but if it is helping, then just comment live, and that will give me enough feedback so I can do more and more of these. I might even do them once a month or something like that. So just let me know. And also, I was going to say that if you are watching on YouTube, hit the subscribe button, hit the notification button. There is literally gold in the content that I produce, because I'm just answering real questions from conversations I have every single day. So if you want, if you aren't on YouTube, go on my YouTube channel, hit subscribe, like just get the benefit there. It's free. Like, yes, I have a course. Yes, it's called the Property Investment Accelerator. Yes, that's where I personally mentor people so they become self-sufficient for life using data, using the team that I provide them, processes. But not that course isn't probably for everyone. Like, you may not want to lay down thousands and thousands of dollars on education. So if you just want free education, that is where you get it on my YouTube channel, and also on Insta and Facebook as well. So I'll take one last question right now. I'm just looking at the juiciest question that I can find. I'll go with you again, Lisa. There's so many questions, but I'll just go with you again. So Lisa is asking, would you choose to fix your interest rates right now? Would you choose to fix your interest rates right now or keep them variable? Now, to fix your interest rates means that during the period in which you fixed, you can't refinance to another bank. All right, so that's one downside. If you fix your interest rates, then another downside is that if you have spare money, you can't put it in an offset account. There is no, like, offset accounts don't offset loans that are fixed in nature. So that's another downside. And normally another downside of fixing your interest rates are that what if interest rates fall further? Now, I think we all know that they're probably not going to fall further. So in general, like, there are some great deals out there. Fix your rates. It's probably not a bad idea. None of this is personal advice. In fact, there is not a single professional in Australia that is legally allowed to give you advice of whether you should fix or not fix. So if your broker is telling you what to do, they shouldn't be doing that. But for mine, unless you had an intention to refinance and draw equity from a house by going to another bank in the next year or two, then that is one reason why you wouldn't fix. And another reason why you wouldn't fix is that if you had too much money in an offset account. So that offset account becomes worthless if you fix your rates. So that's the second reason I wouldn't fix. But if you don't have money in an offset account, and you're telling yourself that if I do refinance, I'll just refinance it with the same bank, then you should maybe go ahead and fix. Like, those are some of the key pros and cons that I can see. So I'll probably leave it there. Look, I'm pretty exhausted. It's gone for more than an hour. Hopefully it's brought you value, guys. And once again, if you're watching the replay, just just comment replay. You know, a lot of you guys won't be watching this live, and I want to see how much traction this video gets. I want to see how much value this video is bringing to people, to you guys. So if you're watching the replay, you know, whether it's on Insta, whether it's on YouTube, whether it's on Facebook or LinkedIn, although my LinkedIn's kind of dead, you know, hit the like button, hit the love button, share this, tag people who might benefit from it, and most importantly, comment replay. And once again, I just want to thank you guys for joining. You know, almost 200 people joined from across different channels. It's quite humbling, so I'm really grateful. I'm just here in my spare bedroom. That's the spare bed that we have, so it's pretty cool to be talking to so many people in this forum. And once again, you know, leave a comment live, you know, the comment live if you liked this, if you want more of this, and if you have any other questions, just comment below as well, and I'll use that as stimulus for future content. All right, guys. Well, thank you so much. Have a great what is it today? Monday. And I want to plug myself. If you are, if you do want some structured hand holding, if you want a data-driven way to invest in high growth properties predictably, like I'm not making this stuff up, with positive cash flow, you don't want to go use a buyer's agent, but you may want to invest outside your backyard in a different state or town, then guys, consultingbypk.com. My website actually sucks. I'm the first one to say that. I've just spent a lot of money on a brand new website which will come out soon, but for now it still works, consultingbypk.com, and check it out. You can book a free call with me. That call is only for people who, you know, are actually kind of serious, right? Like you want to work with me, you want to start your passive income journey or accelerate it if you already have some properties. You know, we're going to get growth. Like, of that, there's no doubt. And like, I'm just another property expert. You know, everyone's an expert in Australia. Build your trust in me, do your due diligence on me by following my content, right? Every week on Facebook, YouTube, and Instagram, I post at least 2 client deals. I tag them, I do interviews on YouTube. Build your trust. If you vibe with me, happy to help. I'll leave a comment below. I don't know how to do it like right now. I'll leave a link below to that website, but it's consultingbypk.com. Thanks so much for joining, everyone. And yeah, if there's enough lives, if you comment enough live in the comment section, then I'll probably do another one of these very, very soon. All right, much love and happy investing. Let me figure out how to turn all this stuff off. All right, I'll start with YouTube, which I can't figure out, so I'm going to start with Instagram. And now YouTube.